I'm going to go ahead from there now that we have a little bit of a context of, why and what we were dealing with. We're going to take a peek. This is a really good informational piece that came out at the beginning of the year, actually, from Capital Group, who used to be American Funds. They're one of the largest investment firms in the country, and they've been a really good resource, I think, for me in the 25 years that I've been in business. From day one, they were outstanding in providing information. And so I have looked to them for education over the years. And I'm going to read this off. So imagine going back in time to New Year's Day of 2020 and learning in advance of the biggest events that were coming in the next 5 years. That before we knew about COVID, that COVID was coming and that we would have a steep bear market, big stock market losses, short term, although they were. Inflation would get up over 9%. We would have wars in Ukraine and the Middle East. We'd have a trade war ongoing with China in a very rancorous political environment. That was what was coming. And with the knowledge of that, would you have wanted to invest? Would you have been an investor knowing that that stuff and all of these things came unexpectedly? But even if you knew it, would you have been an investor? And here's a quote here. In my 25 years in the mutual fund business, I've never known a good time to invest. There's always a dozen reasons why it makes sense to wait. We have a new president. We have strife in the Middle East, excessive government regulation, oppressive tax rates, a Congress that is more part of the problem than the solution, says the former Capital Group executive Graham Holloway. Although that may sound like a reflection of the current environment, this is a quote from 1981. The point is, there's always a reason not to invest. And since going back to 20, what has happened since this time? Well, basically, the S&P 500 has doubled. And perhaps it was a little more than doubled, and it may still even be doubled today since the year 2000 before we had heard the word COVID. And so markets have dealt with things. I guess the lesson here is, and we're going to go through some more. Um, we've got what they call Black Monday in 1987. I referenced that when we saw about a 20 some odd percent drop in one day in 1987. The market had been up a little bit and had that big drop and actually finished 1987 slightly positive. Um, and then, we've done quite well since then. The market was 2,500, it went to 2,000, and we're just south of 40,000 today. We had a Kuwait and first Gulf War come around in 1990. There was a recession. We had the collapse of the Soviet Union in 91. We've had currency crisis, peso and ruble, long-term capital management, big hedge fund, roiled the financial markets, Y2K. Y'all remember the angst going up to year 2000? Would the computer systems work on January 1 of 2000? We were all thinking about that. The tech bubble, big technology boom in the late 90s, and that came unraveled in 2000, and there was a big decline in markets that started here in 2000. 9/11 happened to us in 2001. SARS and the second Gulf War in '03. And I will say that there is a missing piece in 2022 that I recall distinctly. And 22 was the third of three straight negative years in the market. And 22 was really exacerbated by, what they call the accounting uh, scandals, where Enron, you remember Enron? So the lesson of Enron and why that was difficult in the markets is that the markets really couldn't tell if the company's earnings were legit or not. And Enron was not alone. There were several. And so that made markets very uncomfortable. If they couldn't tell how much money these companies were making, much less trying to forecast what they would make, then that made markets very uncomfortable. And it sounds similar to today. I think that um, with the tariffs coming in a way that was not anticipated, even if it was anticipated, there was a lot of uncertainty. And so we're in this period of time where analysts are all trying to figure out, well, how much are these companies going to make? How much of their product are they still going to be able to sell? Are consumers willing to pay for it? These are all sort of up in the air unknowns, and markets do not like uncertainty, and hence we saw what we saw over the last few days. After that, avian flu, SARS. You were starting to see viruses, and we had a couple of false starts, swine flu, well, global financial crisis. We all remember what happened in 2008, a very steep decline and a very quick recovery too, or at least a steep recovery got underway. Um, so we survived all of that. Russia, took their first shot at Ukraine back in 2014, the Crimea area. The Brexit vote came around. This was really where the populist movement, I think, started. That was the first Trump administration was coming in. Um, the people over in the UK were frustrated with the rules and regulations that they had to deal with in terms of the EU. And so there was a lot of angst. I know those things sort of diminish over time, but I remember them distinctly. COVID, the entire country shut down. Uh, Another Russian invasion of Ukraine, and what's not listed here is really the inflation genie got out of the bottle. That's how we got to 9% inflation. The Federal Reserve raised the rates from zero-ish to 5-ish percent. The S&P 500 dropped about 18% in 2022. And unfortunately, we didn't get any help from the bond market. We didn't get any help from diversification in 2022. Uh, Lots of bond funds were double-digit losers during this time. And yes, there was a Russian invasion of Ukraine, but the S&P did fall 18% in 2022. And we seem to have forgotten about all that already because 23 and 24 were excellent years in the market. Um, and I suspect that if we look at this chart when Capital Group publishes it again, in next year or in the following years or 10 years from now in 2025, you're going to see tariff war, trade war, whatever we choose to call it, will be the next in a very long list of things. And here, in all previous times, we have survived this type of thing and moved forward. And I suspect that we will figure it out. Look, either what the administration is trying to do will work and be effective to some extent, or it won't. And if it doesn't, I suspect the country will change course. Either way, I personally am an optimistic type. I think we'll be just fine, whether it works for us or it doesn't. And we'll find our way forward. That's just my personal opinion. Um, I will say, though, that you're going to hear lots of forecasts for recession coming. All of the investment firms are increasing their likelihood of a recession. And so we'll have lots of discussions about what does that mean? How do investors fare in recessions and so forth? I'm sure you'll see some data coming out on that. But I will say, and it's just important to note that, an analogy I like to use is if the economy is heading for some kind of deep freeze, um, there are some heaters that come on. And interest rates have already fallen significantly. And so that's why, if there's some sort of recession anticipated, then the Fed is going to get a lot of questions about what are you going to do about it? Their typical playbook is to lower rates. Well, they're trying to figure out how much inflation is involved here at the same time, but there's going to be a lot of pressure on the Fed to lower the rates. There are lots of forecasts out there about how many rate cuts are coming, or not. But typically, that is what I would call there's a heater coming on. If the economy is heading into the deep freeze a little bit, there's a heater, and it's in the form of lower interest rates. Additionally, oil prices fell over 7% 2 consecutive days. Both of those numbers were bigger than the stock market decline that we just saw on Thursday and Friday. Oil prices were already down for the year. They're down somewhere in the neighborhood of 30% right now. And so if the cost of moving transportation, moving goods all over the country is coming down, well, that's helpful in terms of inflation. Um, Excuse me. Helpful in terms of the inflation problem, perhaps, that the Fed is dealing with. Um, and, that is another help, hopefully, a way for us to head off some of the economic worries that are coming. I will say with the interest rates doing what they're doing, back here in 2022, when we had a negative market and uh, negative results for bondholders, the Diversification did not help. I will say this year, with interest rates falling, and they were falling even previous to these last couple of days, bondholders that were having a pretty good year, even though the stock market was down a bit. Um, the portfolios looked pretty, I would say, reasonably healthy because the diversification was working. International investments had perked up. Um, Bondholders had made pretty good money for the first quarter of the year, and that had offset quite a bit of the negative markets in the United States. And so, um, given the last couple of days, the portfolios aren't quite as healthy looking as they were, but the fact of international outperforming a little bit and bonds making real money has helped quite a bit. So the diversification has been helpful. I'm going to go ahead and bring this to a close. It's been a long filibuster here for you guys to listen in on a Saturday morning. And I look forward to chatting with all of you individually about your personal portfolios and financial plans. And I hope the information is helpful for you with a little bit of perspective. And then we will apply it to your personal situation as it goes. Feel free to email me and text. Um, if you want to chat in the meantime, I'm happy to do it. Look forward to it. This is the time that I look forward to having these conversations with all of you. In large part, that's why you have us here, and it's our pleasure to be of assistance. Okay, doke, guys. Have yourselves a good rest of your weekend.